This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
For me, what's exciting is to see that we now are starting to see that proliferation. S2G is doing some really creative things, a lot more than Frank has even talked about in terms of like some really interesting forays into new approaches that they're doing. We're starting to see that more robust capital ecosystem come together, and that's exciting.
Hi, everyone. In our last episode, which was the first in our series on the missing middle in climate finance in partnership with Spring Lane Capital, we discussed how the lack of growth capital for climate technologies is a real problem. We focused on the role of family offices and bringing more flexibility to help fill this gap. Today's episode is the second episode in the series, and we go deeper into how the missing middle is a structural issue requiring new thinking and new approaches. We're joined by Rob Day, co-founder of Spring Lane Capital, and by Francis O'Sullivan, managing director at S2G Investments. Both Rob and Francis are true thought leaders in this field who bring decades of experience and perspective on where we're at and how we might possibly address the missing middle conundrum. In this conversation, we talk about Rob and Francis's history in climate investing, about how the missing middle is showing up in visible ways, why they see it as a structural issue given the needs of different types of climate investors, some tangible new approaches they're excited about, and where this moment fits in the history of climate investing. This is a rich conversation with two true experts. Hope you learn as much as I did. Enjoy. Frank and Rob, welcome to Invested in Climate. Great to see you both.
Great to see you.
It's great to be here, Jason.
Let's get started and just get to know you both a bit. You're both investors and thought leaders thinking big about how we'll finance the climate transition and backing a range of companies to do it. Frank, let's start with you. You're an engineer by training. You spent time at McKinsey, at MIT, and in the wind industry. What got you into investing?
Yeah, good question. I've certainly had a bit of a random walk. I think it appears, at least, maybe to end up in the current seat that I have. Ultimately, I'm doing what I'm doing today because when the team at S2G was putting together their energy strategy, I think there was a desire to have within the team somebody who had some technical experience in energy. I had a lot of technical experience in energy during my time at MIT. Somebody who had capital allocation experience at scale in the energy business, which I'd had was at Lincoln and at Ørsted, and somebody who had time and active experience in energy policy. And I had quite a bit of that both at MIT and during the period when Secretary Moniz was the US Energy Secretary, helping his team on issues. And that kind of led to me having a slightly unusual profile that I think fit the needs of the S2G mandate. And that's how I ended up in the seat.
Fantastic. And before we move on to Rob, tell us a bit about S2G and how the firm stands out.
Yeah, so S2G is a multi-stage investor across several sustainability themes. The firm's genesis was really in food and agriculture, but over the years, the business has grown to encompass oceans and water, and most recently, clean energy. Today, we invest across all of those themes. A lot of the focus, particularly on the energy business, is on early growth and growth equity investing. But we've spanned the gamut from really early stage venture right the way through into structured credit.
Rob, over to you. You've been investing in climate tech now for over 20 years. What got you into investing in climate so long ago?
An accident. So I started out my career at an environmental economics think tank in Washington, D.C. called the World Resources Institute. I do have an economics degree. Going to an actual economics think tank, it became pretty clear how mediocre of an economist I truly was. They sent me instead to go work with big companies, helping them figure out how they could make more profits themselves, but by viewing the world through a sustainability lens. And we basically got paid in return in case studies. And the whole idea was to build these case studies of how you can make better financial returns as a business and then as an investor by viewing these opportunity sets that would help make the world a better place and reduce waste, and how that can actually not be a cost, but an investment that pays off. And I decided that made a lot of sense, but there I was at a nonprofit in Washington, D.C. So I went off to business school to figure out how to become a clean energy entrepreneur. Came out of business school at a spectacularly bad time to be an entrepreneur of any stripe. So went into 2.5 years in management consulting, Bain & Company, not McKinsey. So Frank and I can hash that out afterwards. And then left management consulting to figure out what clean energy startup I was then going to join, and instead stumbled into entry investment team role of fledgling growth stage clean tech venture capital startup before there were many growth stage clean tech ventures, which was just my entry point in. So I got to do growth stage there. Then I shifted to doing early stage for a few years. And then myself and my now partners launched a family office, basically investing on behalf of one family to really cover a much broader white space and try to figure out the answer to the question. If you actually wanted to make superior risk-adjusted returns off of the sustainability megatrend in private markets, what would you do? And that eventually led us to the recipe that then we spun out and formed Spring Lane Capital around.
Very cool. Well, you're not the first World Resources Institute alum to be on the podcast. Very cool to see how people use that as a springboard in addition to doing the amazing work that the organization does. So not actually that surprising of a journey. So tell us about the start of Spring Lane. You started about 8 years ago. What was the thesis that got the firm started?
Well, like I said, we were at a single family office and trying to take advantage of our flexibility because we hadn't raised funds around a particular strategy, and we had fewer of the typical limitations of an institutional investor shop. And one of the things we did is we helped found a whole network of like-minded family offices and merged it with another one that we were part of. And it's now called the CREO Syndicate. It's got, I forget how many dozens of families and tens of billions of dollars of collective assets under management amongst all those different families. And the reason I bring them up is because that let us not only look across the different activities we'd done, early stage, growth stage, infrastructure, structured finance. We actually even acted as limited partners, basically putting money into other investment funds in a small way, obviously. But not only did we get to learn from our own activities, but learn from watching a whole bunch of other really smart investors and flexible investors as they were tackling new approaches. And one thing that came through loud and clear, not only to us, but funnily enough, to other people who were in the same rooms within that pretty, at the time, quiet group. But one of the things that we kept seeing over and over again is that venture capital kept helping these companies get to a point where they had successfully commercialized a new solution, for instance, in climate. And then there was these huge pools of Wall Street and other places, infrastructure capital, billions upon billions of dollars that wanted to deploy solutions when they considered them ready. But there was a big gulf between where venture capital and other early stage capital could take these companies and when infrastructure wanted to pick up the baton. The way I shorthand it is the venture capitalists would see the first of these solutions roll out into the world and figured their job was done. And meanwhile, infrastructure firms want to race to be the first to do the 10th of something. And so that leaves a gap in between. And we'd seen that we had a recipe for addressing that in some early work we had done in the distributed solar space around rooftop solar and community solar. And we said, okay, this needs to be rolled out across the other 99% of the sustainability universe. Making a very long story simpler, we eventually launched Spring Lane Capital, raised our first fund, and we're now on our second fund.
Great. And what about industry focus? As you said, it's not just solar. So you were taking the lessons from solar and applying them across other industries. Do you have an industry of preference or areas where you focus?
No, it's pretty broad across sustainability. In fact, I would say we're not really sector specific as much as we are thesis driven around the fact that the world needs more of everything, but especially more efficient use of everything. And we're going to see some large scale institutional and especially industrial scale shifts across energy, food, water, waste, and transportation. We look broadly across all those areas. And in fact, many times what we look at blur the lines between those. Maybe it's a water treatment technology that also generates clean energy along the way. So it's water and energy, for instance, and waste for that matter.
Great. And you mentioned that you're on the second fund. How has the thesis evolved, if at all, since your first fund back in 2017?
I think we've gotten some good confirmation that when we can help not only provide the capital, but a lot of assistance in institutionalizing project delivery, because we tend to think in terms of projects. I alluded to it before, but we think about it in terms of, okay, we're finding somebody who is ready for deployment capital, which we tend to think of as being a form of project finance. When we find somebody who is ready and really needs 2 to 3 years worth of institutional deployment capital, we've learned we really need to roll up our sleeves and be as helpful as possible to help them get institutional grade in their project delivery, managing construction, getting the contracts in a way where they're going to be ready for that follow-on infrastructure capital. And we've just gotten a lot of validation that when we can do that successfully and see the company get to that magical making up the number 10th such deployment, that then there really is a lot of capital that is eager to take it from there. So I would say what's evolved is a little bit of flexibility as to how structures we put together can apply to different types of situations, whether it's a manufacturing facility or wastewater treatment plant, or we've even financed fleets of vehicles. But it's also just really reaffirming that we need to do everything we can to help and really be a partner with that company, not just a financier.
Fantastic. Thank you both for that context. We're here, of course, as part of a series developed in partnership with Spring Lane Capital, focused on the missing middle. And Rob, you've already teed that up pretty nicely with talking about the gap that you've been focusing on. But Frank, you've been focusing on it as well. You published a report in 2023 that has proven quite influential. It got a lot of people talking about the missing middle. Climate investment seemed like it was growing in lots of positive ways. And you came along and gave us all a reality check of sorts. Not sure if you always do that when there's a party going on. You brought us down a notch, but it was a good reality check. What got you thinking about the missing middle and led you to conduct the research that led to your report?
First, I'm not sure the intention was to spoil the party. If anything, I think the intention was to try and figure out how we can extend the party. The genesis of that work, Jason, was really focused on the first fund, the first energy fund at S2G. It was a little unusual in that we had quite a broad spectrum in terms of the stage that we were investing in from that fund. So we were doing some real early stage investing, or at least investing into what I would describe as earlier stage opportunities. Let's call it true tough tech. We were doing quite a bit of investing into development platforms. So these are businesses ultimately deploying what are deployed at scale today, wind, solar, storage, etc. And then we had quite a large amount of exposure to what we'd call early growth equity as well. So these were businesses, cleaner tech businesses that were revenue generative, and most of them were profitable, at least at some scale. And what was interesting really was like reflecting on the journey from that earlier stage through the gestation period of a concept or a product or a project, as Rob was mentioning, and what it would take to successfully see a handoff from the earlier stage investors to the ultimate late stage investors. And what we witnessed, or what we noticed, was that there was a lack of intersection really between the earlier stage ecosystem in general, but particularly earlier stage investors and those later stage investors. And what was interesting for us, much like what Rob and colleagues at Spring Lane have done, is we were doing some in-between stuff because we had a mandate that was quite flexible. And we were just spending a bit of time trying to reflect on what it was that allowed us to do that. When we stepped back, we decided, let's bring some rigor to the process. I have a colleague, Gokul Raghavan, who was formerly a very senior analyst at Fidelity, had a lot of quantitative capability. I myself have a quantitative leaning. And so we dove into the data and looked at it through a number of different lenses. And what really struck us was that if we look at the broader private capital markets focusing in on the clean tech opportunity, oftentimes people would speak about it as a singular concept. But in reality, capital was being allocated and is allocated, actually, it still is the case, in a very siloed manner. So at the very tippy top of the cash pile, you have capital allocators. And those allocators have tended to focus on infrastructure assets, so really large scale assets that require a lot of capital with modest returns, but that are really heavily downside protected. And of course, that's to our ability to deploy huge amounts of wind and solar and so on. That's great. As Rob kind of precisely put it, those guys are not interested in being the first to anything new to the table. And in the transition story, we need to be able to gestate newer concepts and bring them through. The early stage investors were, of course, doing that. But what was apparent was they kept on getting to a place where the check sizes that were required for the next round of funding for their companies were larger than they were able to write in many instances. The return profile of that next stage of the company was meaningfully lower than what they really wanted to underwrite, and they had told their capital allocators they would deliver. And you still had very meaningful risk in terms of proving out the project or proving out the widget, etc. What was striking to us was that, again, going back to the top of that cash pile, allocators were continuing to push money into the infra. They were happy with that. They were interested in putting money into earlier stage activity, but the vast majority of that money was really flowing into true earlier stage firms. That's okay, but those early stage firms have a specific mandate, and it's focused on delivering a return within that context, not necessarily handing off to the next stage and then allowing further gestation. So there was this gap in between where it varies, but we'd suggest people would need to be able to bring 30, 40, $50 million checks to bear and be underwriting a 3 to 5x return, maybe rather than a 5 to 10x return, where there was very little money flowing from the allocators at all. And there weren't very many managers in there that were focusing in on that. And that we spent a bit of time diving into. We were viewing this as a missing middle. There are many versions of that, but we felt that was a missing middle. What was interesting was we did a little bit of an experiment, or a retrospective experiment rather, where we looked at where money had been deployed over the last number of years, looked at the expected burn rate of those companies, and looked at the scale of the check that they would need to move through to the next phase, and then looked at the available check pool at those various stages. And what we found was that in the earlier stage, there was more than adequate capital available. I'd argue in some instances, maybe too much money. That money leads to competition for deals. That competition for deals drives valuations higher. And then when you step into the next phase, the missing middle, there was a deficit, a very meaningful deficit of money actually relative to the deal flow that you would expect to see coming through. That, of course, provides pricing power to those allocators or those investors. And there was a real tension at that interface, good ideas coming up, but with high valuations, investors there not wanting to take a mark on their money necessarily, investors at the later stage not willing to overpay because they felt, look, we're not going to be able to see this return ourselves. And unfortunately, that is a structural issue. That is a challenge. There's nobody to blame for that structural issue in many respects, because it has evolved from long-term paradigms and how capital is allocated. But I think we as a broader group, we as a broader sector need to rethink some of the structures around capital allocation, and our money allocators might need to do that too, if we are going to help accelerate this transition and help bring good companies through that middle phase of their maturity. And this is exactly something that Rob and the team are doing. We at S2G are certainly, within the context and the capabilities we have, trying to do some of that, because we actually believe that there's really a lot of very attractive opportunity there. And nothing could be better for our sector than to be able to demonstrate interesting returns from companies in this space. It's going to help us draw in more money. It's going to help eliminate, I think, some of the jaundiced views that you often hear about investing in this space. And so if we can collectively address this challenge, I think we can deliver a big impact in helping to move the overall exercise forward.
Let me just jump in and explicate on something. And first of all, this is why it's great to have Frank and S2G on this, because given their position and what they're doing in the marketplace, this kind of thinking about the core of the structures and the ins and outs of the market, and then identifying what needs to be solved in that. They've been really innovative and forward thinking on this for many years, not just on this one study. And so we really like the team at S2G and like getting to work with them. And this is just really thought-provoking stuff. And one thing which I just wanted to call out, which I think helps put a couple of pieces together of what Frank was just saying, is venture capital structures tend to have a valuation that's tied to how much you're raising within that structure. So the best way I can illustrate it is if you're that early growth stage or you're further along growth stage and you're trying to build something that costs $100 million and you're too early for project debt and you're too early for off balance sheet infrastructure capital. And so your venture investors are like, well, okay, we got to put in $100 million to build this first facility. Nobody wants that $100 million that comes in to take more than half of the company. So you've just automatically said that the company is going to be at least 100 million before you then put in 100 million to now be like a $200 million company. And the people who put in that new 100 million want at least a 5x at least off of that. And so by the time you sell the company, even if you don't raise another dime, you've promised that you need to sell the company for $1 billion or IPO the company. And it becomes very quickly like become a $1 billion company or bust. And there are so few $1 billion exits every year that too often the story ends up with a bust. And so that's exactly what Frank's talking about there. Really helps explain why it's been so tough to put money at those markets. It almost doesn't even matter what the valuation was at the early stage. It really comes down to the size of the check. Whereas if what you could do is say, okay, great, through being a bit more creative and bringing more of a robust capital ecosystem together, we can make that Series D, say, of venture capital be less than the $100 million and fill in the rest with something else. Then you can keep the valuation reasonable and then you can make everybody be able to make money. And it all starts, though, with an identification of the problem, just like that study did. It's such a useful study.
Let's go deeper into that. As you say, it starts with naming the problem. The report came out almost 2 years ago, and it certainly helped get people talking. So I'm curious, what's the state of play? Everyone knows it's a problem. What's being done, or what do you think needs to be done?
Difficult to say, to be honest, Jason. I will say the following. I mean, there's nothing particularly truly novel in certainly the work we did. We found it helpful ourselves, but I think people have, what has played out over the last couple of years, though, is that we have arrived at another point in the kind of the life cycle of another cycle in cleantech, where there are a number of very interesting companies that are evolving out of that earlier stage period into, let's call it the second trimester of their gestation. And now this becomes a real need. And there are more of them and there's more opportunity if you can solve that. There's an ever increasingly pressing need to get these solutions through and have them be successful. And of course, I mean, there's also, I think, an increasingly, and certainly in the last while, increasingly challenging, let's call it, broader political context. So it makes it even more difficult, but yet even more important to go after it. Folks in the industry understand this. I think you see more and more investors that are beginning to evolve and innovate in the type of offering they can bring to the table. So, you know, view Rob as kind of the man in the vanguard there, but this is a business where folks figure it out and see where the market's going and begin to move in that direction. We are seeing progress. With that said, I do think that there remains a challenge, Jason, and the challenge is that aside from, let's say, the larger family offices and some other kind of slightly atypical operations, standard institutional investors who have standard LP profiles and so on, they have a challenge in that they have to look at the opportunity in front of them, the space in front of them, and they then also have to go back to their LP set and they have to educate them, help them move through this process, better understand it. And I think there's a real organizational challenge in that respect, because at the LP level, at the very tip top, you have managers, they're given an allocation of capital. And the guys and girls that are in charge of the infrastructure, they have no incentive to take on any more risk. The guys at the early stage allocation, they're either not incentivized or, by the way, many of them may not be still there, candidly, depending on how their allocator is thinking about the situation. So I think we still have a lot of work to do in helping allocators see that it is in their very best interest to rethink how they're sending money downstream into the investor groups. Ultimately, their business is very simple. They're just like, hey, I need something to put money. I need a place to put the money, and I want that to have the largest spread possible, the highest return possible. The reality is that there's now a lot of money chasing a relatively modest return profile from things like conventional wind, solar, and storage. We need to offer them new things to invest in that can go to real scale. There's lots of that coming out, but they themselves need to help feed that machine now. So my view is that we have to help those allocators still see that there's an opportunity here in between, be willing to put money into the missing middle, not necessarily to earn major returns themselves from that allocation, because by the way, they're not doing that at the early stage either in reality. It's just not big enough. But by putting money to the missing middle, they are going to create enormous opportunity for their meat and potatoes, day-to-day stuff to allocate large volumes of capital into it over the next 5-10 years. That's beginning to happen in some instances, but I still think we have work to do. I don't know, Rob, I'd love your thoughts on that, but that's my sense from the conversations that I have. People kind of get it, but it's a hard problem to solve.
Yeah, I think you're spot on. And they have their own organizational issues too. Let me tell you how much fun it was to raise a first-time fund, technically speaking, even though we'd been investing together for years. But because we're spinning out of a family office, we were a first-time fund in what was at the time an out-of-favor sustainability. This was back in 2018, out-of-favor sustainability sector, but especially with a new investment model because we put money into the companies and their projects, both. Even our anchor limited partner for our first fund was like, we don't know which team for you to talk to. Is it real assets? Is it the infra team? Is it the private equity team? Is it venture capital? What is it? And we were like, we know it's not venture capital, but other than that, you tell us. But they were at least forward thinking enough to work through all of those kind of organizational challenges and siloing. But too many of these institutional investors, they have silos for a reason, and they have a team that, isn't going to say, great, let's try to put the chocolate and the peanut butter together internally to figure out that we should invest into this new firm or this new model.
I should say, Jason, like this piece of work, I obviously like dining out on it whenever possible, although that's becoming rarer at this stage. We have some new stuff coming out shortly, which will be interesting as a follow-up. But when we first brought that piece of work out, we had a lot of interesting conversations with allocators and the most interesting allocators. And they would freely admit, we completely get it. Like, it's nothing gee whiz. But they're like, we actually have a problem internally because, hey, we've set up this fund and now there are 5 or 6 folks. They've all got carry in this fund. And like, how do we retweak this? That kind of structural challenge is salient. I think it remains salient. And over time, like all things in energy, this is an inertia business. I think it will change. The question is, can we accelerate that even marginally? Again, something like what Rob does allows that acceleration to take place. And the energy business, like, again, it's not a step change business, in my view. It's just not. It is an inertia. Small change in inertia, but can have a huge impact. And so I think we're in that space right now. You're beginning to see that inertial shift, and that will bring with it enormous and long-lasting impacts over the next while, but it's still a little bit difficult to see that impact today.
Yeah, sorry, you can tell we're of the same mind. Not only are we jumping on and riffing off of each other's answers, but we keep also using food analogies. This has become a very food-focused forecast between the meat and potatoes and the chocolate and dining out. I think one of the things which we keep seeing as well is that it really is going to take a proliferation of different investment models. There's no sort of one investment model that's better than everything else because these sectors, energy, food, water, waste, transportation, they vary so much. They have different needs. One of the things that, has always struck me, though, is that we do have a precedent for it in more traditional energy because that evolved over time to the sort of inertia and changes on the margin that Frank was just talking about. But that evolved over time to be able to have, upstream, downstream, midstream, different basins, different risk reward structures within each of those different things, end use that these private equity investors in oil and gas can be investing into, for instance. So for an allocator, there was this ready set of options for them and thinking about, okay, I need this kind of risk reward. And at this point in the economic cycle and with this thesis, okay, great. Now there's at least a half dozen managers who do exactly that for me to go talk to. And for too many years, for most of my career, We haven't had that in, call it clean tech, call it climate solutions, call it sustainability. We just haven't. For way too long, we just had like venture capital and infrastructure. That you can have chocolate or vanilla, and that's it. You keep using food. For me, what's exciting is to see that we now are starting to see that proliferation. S2G is doing some really creative things, a lot more than Frank has even talked about in terms of like some really interesting forays into new approaches that they're doing. We see people who are coming with creative debt. We're seeing people coming with DevEx, development expense, pre-construction specific financing. Now people are talking about first of a kind financing in particular. We're starting to see that more robust capital ecosystem come together, and that's exciting.
Rob, I want to circle back to the question of allocators and what it takes to get them interested in this space where there are structural challenges. And we haven't even talked really that much about the return profile. You mentioned it in passing, but one thing that I noticed in reading the reports that was recently released by Creo, which was the focus of the first episode in this series, if you haven't yet listened to it, but it points to the fact that this stage of climate investing is the only stage of climate investing that hasn't matched the ROI of the market for general venture. So particularly with that data point, tell us about what it took to raise the second fund. You recently closed a fund of almost $300 million, so a lot of interest. Tell us the story that you used, or what does it take to be able to get allocators interested?
Proof points, first and foremost, is important. And I think what you're talking about in that Creo report is it was talking specifically about like growth stage and why that's sort of fallen short versus other verticals, I would say. And one of the things I personally think has driven that, having talked obviously with the folks at Creo who pulled that together, is because so many of the innovations in these sectors that we invest into are physical. And so they're going to require steel in the ground or significant hardware to be deployed to be successful, because people generally aren't going to buy a company that has a good idea. They want to see the good idea actually have been proven out in real world conditions, and not just once, but a bunch of times, and have growing revenues, et cetera. And you can't grow the revenues without having deployed the solutions. So one of the problems there is what we were talking about a few minutes ago, about how that raises the amount of capital that you need at that growth stage. And then that messes up the whole return math, which in my mind, venture capital math, even growth equity generally follows venture capital math. If you're just doing all of that through the startup itself and structuring your capital for steel on the ground through the startup, you're going to end up necessarily having to overvalue companies. So what we see quite often is either the growth equity came in at too big of a check size, which meant too high of a valuation size, which then ends up chasing those billion-dollar exits that are so few and far between, or they come in too early. And we see that as well. And, what's called growth stage in many other sectors of the financial world is quite often later, when you're talking about like software, for instance, than growth stage. I see a lot of pre-revenue growth rounds in our sectors. It's almost an internal inconsistency. I think one of the things that we did to directly answer your question is we've shown that, okay, we do have this somewhat strange investment model where we do basically two deals at once. We're going to back your company and we're going to back your projects. But at the same time, we're doing that in a way where we're helping you keep your venture capital and growth equity needs relatively lower. And that helps you be better positioned for a successful exit for everybody involved on that side. And by the way, this is what we saw in the solar space and we've seen as well. We can come in and be, frankly, expensive project equity. I tell people all the time who are entrepreneurs, if you already have project equity, you probably don't need it. And that's totally fine. We're still cheaper if your alternative is growth equity and funding everything through the corporate, because that's even more expensive capital than us. So then we can go back to those institutional investors who are backing us and say, see, we're basically taking infrastructure type risk, but generating higher returns than you get from putting it into, it's exactly what Frank was talking about. Great. There's all this interest in solar and wind. How do we get them interested in relatively newer things? And the answer is demonstrate that there are better returns.
Let's double click. Let's make it more tangible. And here's some examples. Rob, will point to you first, since you're just talking about being able to point to examples as part of your pitch. Without picking favorites, tell us about a few.
Yeah, I'll be really brief because I want to hear Frank's take on this as well. But we've got a couple. One that we exited is in the distributed wastewater treatment space. There's a company that we backed that had a couple of systems already sold. Their systems go behind like a cheese making factory, a brewery, something with highly organic, concentrated organic wastewater. The local sewer treatment authority hates that. A lot of those facilities are finding it very hard to get their permits necessary to expand operations or to build a new plant, or they were getting charged out the wazoo. for putting all that, to speak technically for a second, highly gunky wastewater into the sewer. And so they had a beautiful solution for that, but each of their systems costs, it varies, but let's just say $20 million each. That was going to be really tough to build a fleet of those and put them out there. They had customers who were saying, I don't want to pay $20 million to own this system and then have to run it myself, but can you just run it for me? And the answer was they could run it. Like a half dozen of those, the company needed like over $100 million. So it adds up really quick, even at relatively small check sizes per project. We were able to back them as they introduced that new sort of wastewater treatment as a service model into the marketplace, build up a couple of really high profile projects. And then they ended up getting acquired by a larger infrastructure firm that wanted to roll that out at scale and roll it out nationwide. That's one example. And then the other one I would point to, it's a company that does green data centers. And green data centers, a lot of people say that kind of stuff. For us, what they're really doing is co-locating with wind and solar farms. It's a company called Soluna. And they build a data center right there that is intended to utilize otherwise curtailed power. So if you're in ERCOT, Texas, or many other regions, even when the wind blows, sometimes particularly because the wind's blowing really well, you can't sell your power from the wind farm hundreds of miles away to where it's actually going to be consumed because of transmission. And there are a number of different solutions to that, but their solution is to say, hey, data is actually geographically fungible. So why don't we build a data center right there? And for at least a third of our power, we'll take what would otherwise have been spilled power, where the wind farm says, hey, it's great wind right now, but we don't want to even let the wind turbines turn because then we'd have to sell our power at a loss, or at least for really cheap. That's one where it's a different configuration of data center. People aren't used to co-locating data centers with wind farms literally on the same site as the wind farm. We've been helpful to them as they've been able to grow up what is now a well over $1 billion pipeline of projects because they're really solving a problem for big IPPs. But I know like Frank and team have a bunch of really interesting stuff that they're doing.
Yeah. Always tricky to talk about actual deals for lots of reasons, Jason. But I will say, I'll give you an example, which is out of one of our portcos that we found captured a number of the challenges that we often see in missing middle. The particular business was at scale business in the mobile power space. And their challenge was that they have a very interesting innovation that has seen a very significant market uptake. But they needed fresh capital at scale, candidly, to support the growth of that in juxtaposed to their core business. The nature of their core business was one that probably meant the valuation metrics that typical investors would use for a straight equity investment were not going to yield them a very attractive return. Yet their new innovation, they felt, was going to be really attractive and was going to boost valuations enormously. And so the team, the founders, who themselves had not taken very much money at all previously, really were in this kind of in-between space where they didn't want to be valued on the basis of what could be valued from the kind of ex-post analysis of their core business. And yet nobody was really willing to take a punt at the scale in order to fund and value their new innovation. And so rather than just doing a straight equity investment, we did a much more structured instrument. Now, you can't always do it, but this business, coming back to Rob's point about what is a growth company, this is a business that generates cash. And so they were able to nominally support the instrument that we were putting in place. We were able to have a target return on that preferred instrument. Once that target is hit, that instrument is going to be retired. Now, that instrument is going to be a nice return from our point of view, but there is the potential that this be a very successful outcome for the company. What we said to the founding team was, look, we need a little bit of upside here, guys. So that upside will come from us having a tail ownership in the business subsequent to us retiring the preferred instrument. But you guys are going to have all of your governance back, et cetera, et cetera. And that particular combination of that instrument or that combined set of instruments was much more interesting for them than what they were getting from the kind of more traditional options that they were seeing in the market. Ultimately, we've done the deal. That deal is moving forward. That business has had a very successful year thus far based on this. We'll probably be taken out a little bit earlier because we gave them that option. And that won't be amazing for us, but it'll be fine. It's still a good return. But long story short, that's a slightly hairy concept. It's not typical. I think we need a lot more of this type of activity in the market, because coming back to something that Rob was saying, you got to meet the businesses where they're at in terms of their capital needs and the capital structure that is right for the business. And I would argue that for too long, we've been trying to, it's here, I have a hammer, everything's a nail. We need to at least get a few hammers, and we need to start deploying various hammers, because there is nuance out there. And if you can address that nuance, you can have a much more benign capital structure for these businesses, which will allow for mediocre outcomes to occur as well. What we really face, unfortunately, with some of the kind of traditional earlier stage models is that it needs to be a home run, or else it's bad news for almost everybody. By contrast, in the utility space, there's no opportunity for a home run. In the missing middle, there are opportunities for home runs, but at the same time, you have to be reasonable and expect that as these businesses do scale, some of them might just be mediocre, but that's okay. You can still make money in that context. And so that's what we're working on. And we're seeing there's a lot of deal flow in that space. I would also say the check size that we wrote there was a meaningfully large check size, right? So multiple, like 50 million plus type check size. There is a wedge of the market that needs checks like that. There's a segment of the market that doesn't need $100 million, $200 million check sizes, but at the same time, they can't work with $10 or $15 million check sizes or 20 from 3 or 4 different characters. They want 50, and they want 1 or 2 partners to work with. And so we've been plowing a furrow in that space, Jason, and we think there's more to do there. And there's lots of opportunity for all our peer investors to be there too, I think.
Another food analogy like it. Frank, I'm going to ask you to rewind, and I understand you can't go into very specific details, but when you were talking about a structured instrument, Bob was nodding knowingly, but I imagine a lot of listeners don't know exactly what you're talking about. And I know that you're also a teacher, so give us a quick high level on what that means, because I'm imagining it could range from anything from a little bit of debt that gets repaid to royalties or to other ways.
Great point. Yeah, absolutely. Well, in this instance, it's really a structured equity instrument. So what I mean by that is that you have a preferred equity category that effectively gets paid in a waterfall manner, versus there are preferred equity concepts in more plain vanilla equity deals where you get your money back, but you're getting a proportion of the total quantum, whatever that happens to be. In this particular instance, we have a defined quantum of money that we're going to get back, and that's giving us a predefined multiple on the money that we invested. So you can view it almost as debt in reality, but it comes with governance, a la a typical equity investment, board representation, decision-making, governance, and so on. And once that instrument and its targets are hit, it goes away. The cap table now reverts back to a common equity cap table, if you wish. We're going to have a slice of that common equity. But most importantly for these founders in this instance, they're not diluted anymore. That encumbrance goes away, just like if you had paid off your debt. There's endless concepts in structure, but that's a structure that we brought to that particular deal that was fit for purpose, as I said, Jason, that worked for that deal. Doesn't work for other deals. It worked for that deal because this business was able to give us confidence that they could pay it back, candidly. Even if the business wasn't the new business wasn't a roaring success, the core business was sufficient to be able to service that inwardly.
Thank you. I think that we've delivered here on describing the problem, describing the need for some creative solutions, and then actually describing what some of those creative solutions can be and how they work for everyone, for the investors as well as for the founders. Let's zoom out as we close out this episode and understand the missing middle with just a little bit more context of where it fits really in the history of climate investing. And you've both been doing this for quite a while. And so I'm really curious, both Rob, with your hat as being investor, Frank, yours being investor as well as researcher, is how you see the big picture. If you think about the last couple decades of climate investing as a series of chapters, how would you describe those chapters, and what chapter are we in now, and where do you see things going? Frank, why don't I hand off to you for a brief response, and then we'll hand off to Rob to close us out.
Yeah, I've thought about this. I probably view let me reflect on my views of the phases of the energy transition first, Jason, and then I'll come back to how that reflects on the market. So I think we're at the start of the final and third phase of the energy transition. That's really kind of wide scale, large scale deployment across the economy. So this isn't just about electricity. It's about cleaner mobility. It's about cleaner industrial processes. It's about efficiency broadly defined. If we rewind all the way to the start of the transition probably coincided with whatever we'll call it, Clean Tech 1.0, a lot of excitement about technology innovation or things like solar back in the day, which saw a lot of venture money come in and then really very quickly realize, and this was venture money without a whole lot of energy context and experience, candidly, supported a lot of really interesting technical innovation, but did not recognize the realities of the timelines and the scale that's involved in actually building out these infrastructure type products at the end of the day. That was like the first step. It was the Clean Tech 1.0 innovation phase. Then we went into the second phase where we're just ending, as I said, which is meaningful, albeit slightly limited deployment. So we have seen one sector fully embrace the clean transition, and that is the electricity sector. Today, 80% 80 cents of every dollar deployed into capacity in electricity generation is going into a clean form of generation, maybe more in reality. Obviously, some headwinds here again in the United States at the moment, potentially. But I actually, even over the next 4 years, expect that we're going to see continued meaningful acceleration of that. That's meaningful deployment. We need to take this next step, which is mainstreaming. Mainstreaming require, and by the way, that meaningful deployment, that was made possible by that kind of like low risk infrastructure capital, figuring this out, having a good cost basis and kind of building and building. Those guys, as I said, are not really keen to do different things. Now what's in front of them is this opportunity to take those clean electrons and to broadly distribute them into the rest of the economy. People that need support in the missing middle are bringing those solutions to the table today. Whether it's in mobility, whether it's in industrial process decarbonization, whether it's in efficiency, writ large, etc. Those solutions require some added scale and some added de-risking in order for them to then fall into the kind of infra categories that they need to. So I believe that the missing middle, as we're currently, or as we've been discussing, this is a kind of a temporal thing. We're going to figure this out. We're going to unlock some really important technologies. And then ultimately the big money is going to sweep in and it will pull those technologies into the market at an enormous scale. And we will see those other sectors embrace cleaner, more efficient, more secure solutions over the next 10, 15, 20 years. But we've got 5 years in front of us here. That is important because we have had a lot of innovation. There's some really great solutions on the cusp, but they're not quite there yet. And so we need to bring that focus on ensuring that we can give them enough momentum such that they can bridge into that de-risked category. And then we'll need a bit of bravery, by the way, from our capital allocator friends and their infrastructure investor friends to say, you know what, we're going to do this because it makes sense and it's the future of our business. And I think that's probably the most important point. It is the future of this infrastructure capital deployment business too. There's only so much wind and solar that we can continue to pump out, but you can multiply that several fold if you start deploying that capital into industrial decarbonization solutions, into the mobility space, into the built environment space. So that's how I think about it, Jason. Perhaps not very articulately, but I think we're at an important moment for the sector right now.
Frank, thank you much. Rob, over to you.
Yeah, that was beautifully captured, actually. I'll be brief because I'll just mention two things. First of all, it's been intimidating the whole time because anybody who's just listening can't see the visual here, but Frank is sitting in front of a whiteboard that's completely covered in very smart looking equations.
Yeah.
It's a really good way to illustrate sort of like, yeah, I'm a researcher and an investor. That's good. I'm going to have to borrow that. No, but the other thing, joking aside, that I would just tack on to what Frank was just saying, because it really was beautifully captured, is I also think we're coming out of a period when this sector has been seen as a very special thing in and of itself. I can't tell you how many times I've talked with like a pension fund that says, okay, we've got our private equity team, we've got our infrastructure team, and we've got our climate team. And it's like, well, why isn't that part of the other two teams? And one of the implications of that is that we really have, as a sector, been trying to reinvent wheels that have been invented in other sectors a long time ago. But it was a great disservice a long time ago to have this be focused on utility scale, clean energy, funded by venture capital. Because then it became this very simplistic and frankly not very rapidly learning from other examples approach to everything. That example Frank gave of the structured equity that they've used with that portfolio company is one just example of how often you see stuff coming out of more traditional transportation specialty finance or more traditional forms of structured finance of other forms that really can port over one-to-one into the kind of stuff that we're investing into. But we're always viewing it through these very simplistic lenses and sometimes even trying to reinvent stuff that's already been well honed elsewhere. And then we wonder why we go to the more established downstream traditional investors and we try to present something to us and they look at us like, why are you doing it that way? To Frank's point, what we really want is for those later stage billions, trillions of dollars of investment dollars to come in and take these interesting early deployments and blow them out at scale. That's the only way we're going to make true impact on this climate change challenge. My message is like those recipes are now pretty well understood. It's a matter of just trying to get the allocators and the investors and especially the entrepreneurs to realize that and start to incorporate that into their planning. It's just not a venture capital game anymore. Nothing against venture capital, but we really need that much more robust capital ecosystem.
Rob, Frank, thank you much for this great conversation and for the work you're doing. Great to see you. Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.